Welcome back to your ultimate pit stop, Piston Pundit. Las Vegas is flashing warning signs once again, and this time the tremors are shaking some of the Strip's most iconic companies. Tourism is slipping, high-end visitors are cutting back, and both MGM and Wynn are reporting financial pressure that hasn't been seen since the post-pandemic turbulence. Behind the glitter is a deeper economic story, one tied to inflation, tariffs, international travel barriers, and shifting consumer priorities across the United States. When Las Vegas slows down, the rest of the country often follows, especially big-ticket sectors like the auto market. Today's Vegas downturn may be tomorrow's national trend. Here are the developments. The Strip's slowdown. Vegas sends America its first warning. Las Vegas has long been a real-time gauge of America's economic mood, measured by crowds, hotel occupancy, and the hum of casino floors. In 2025, that hum has faded. Visitor numbers are down sharply. June fell 11% and September nearly 9%. And international tourism has dropped 13% as Canadians, Mexicans, Europeans, and Asian travelers pull back due to rising costs, political friction, and currency pressures. Canadian travel, in particular, has plunged 30 to 60%. More troubling is how the slowdown extends beyond gaming. Non-gaming revenue is down 8 to 12%. Restaurants have empty tables, luxury stores see weaker traffic, and shows no longer sell out consistently. Tourists say Vegas no longer feels worth the cost, pointing to overpriced drinks, expensive coffee, and escalating resort fees. This mirrors growing national caution. Families skipping vacations often delay major purchases, especially new vehicles. Las Vegas may be showing how Americans will spend in the months ahead. And if Vegas is the first warning light, Wynn shows just how deep that financial strain can run at the top of the luxury ladder. Wynn's $10.5 billion balancing act. Luxury demand starts cracking. Wynn Resorts sits at the heart of the current economic shift, revealing how even top-tier luxury brands feel the strain of weakening consumer confidence. Behind its polished image is a company managing more than $10.5 billion in debt, with nearly $900 million tied to Las Vegas. Its latest earnings show net income plunging over 40% and profit margins slipping below 5%, signaling deeper structural pressure. Non-gaming revenue, critical to Wynn's business, has softened significantly. High-end dining is seeing fewer big spenders, luxury retail has slowed as international travelers scale back, and premium nightlife can no longer offset rising labor, energy, and financing costs. Yet Wynn is still expanding, pouring massive capital into its Al Marjan Island mega-project in the UAE, while simultaneously launching a $150 million share buyback, further straining liquidity. Wynn's clientele mirrors the luxury auto market. When affluent consumers pull back on upscale travel, demand for S-Class sedans, Cayenne turbos, Z06s, and high-end EVs often cools as well. Wynn's struggles reflect a broader shift in global luxury behavior. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. But luxury spending isn't the only part of the Strip feeling the squeeze. Mainstream tourism is flashing its own warning signs, and MGM tells that story clearly. MGM's downturn. Tariffs trigger a mainstream consumer meltdown. While Wynn faces pressure in the luxury segment, MGM Resorts has become the warning signal for the mainstream market. Its latest earnings show net income collapsing 75%, from $187 million to just $49 million. This is especially troubling because MGM's business is diversified across online gambling, regional casinos, and international operations. A 7% revenue drop in Las Vegas reflects wider consumer pullback driven by inflation and tighter household budgets. Much of this slowdown is tied to national policy. Tariff hikes have raised the cost of goods, travel, and cross-border movement. Canadian and Mexican tourists have sharply reduced visits, citing political tension, higher travel expenses, and weaker currency value. Even Southern California visitors, normally a dependable weekend crowd, are showing up less amid stricter enforcement and economic anxiety. These same pressures are hitting the auto market. Tariffs on parts and materials, high interest rates, and rising vehicle prices are pushing consumers to delay purchases. MGM's slump is simply an early indicator of broader consumer caution across the country. Yet MGM is just the domestic side of the story. Globally, even Wynn's strongest overseas engine is running rough as Macau faces new turbulence. Macau's uneven recovery. Wynn's global lifeline starts to slip. Macau was once Wynn's stabilizer, delivering massive VIP gaming profits that balanced Las Vegas volatility. But the market is now far less predictable. Wynn's latest quarter produced $308 million in EBITDA and solid mass market results, yet deeper signs point to instability. Erratic VIP hold rates, strict regulatory oversight, and rising operating costs, especially wages driven by competition for skilled labor. China's slower economic growth and tight currency controls are also limiting how freely high-net-worth travelers can move funds, weakening Wynn's most profitable segment. Even with strong foot traffic, margins remain vulnerable. This instability matters globally. Just as Wynn relies on affluent international travelers, luxury automakers depend on wealthy buyers across China, the Middle East, and North America. When Macau's VIP spending cools, demand for Rolls-Royce, Bentley, Porsche, Lucid, and high-end Tesla models often softens too. Macau's turbulence highlights how exposed all luxury sectors are to shifting geopolitical and economic pressures. But despite these setbacks, Las Vegas may not be stuck in decline, because the next chapter hints at a surprising comeback. The 2026 Rebound. Vegas bets on sports for revival. Despite today's challenges, economists expect Las Vegas to begin a meaningful rebound in 2026. UNLV forecasts the city will regain about 1 million visitors, rising from roughly 39.1 million in 2025 to more than 40 million. This recovery won't be driven by gambling but by sports, which has become one of the Strip's strongest economic engines. With the Raiders, Golden Knights, Aces, NBA prospects, Formula One, and a $2 billion MLB stadium, Las Vegas is transforming into a global sports destination. Major conventions and international events are also showing stronger bookings heading into late 2025. Resorts are shifting strategy as well. Years of aggressive price hikes pushed out middle-class tourists, prompting hotels to reduce fees, moderate food prices, and offer more value-driven packages. This recalibration could restore Las Vegas's broad appeal. The parallel to the auto market is clear. When households regain confidence in leisure spending, major purchases often follow. If 2026 brings renewed travel momentum and stable interest rates, vehicle demand, especially in mid-market segments, could strengthen alongside the Strip's recovery. And with all these forces converging, the bigger question becomes, what does this mean for America's economic engine as a whole? Verdict: the thin ice beneath America's shifting economy. The story unfolding in Las Vegas isn't just entertainment news. It's a preview of the pressures shaping America's financial landscape. The contraction in tourism, the squeeze on luxury resorts, and the volatility in global high-end travel all point toward a shift in consumer behavior. Wynn's balancing act, MGM's declining revenues, and Macau's unpredictable recovery reveal vulnerabilities across both luxury and mainstream markets. Yet the early signs of a 2026 rebound offer a different possibility: a recovery driven by sports tourism, better value propositions, and gradually improving consumer confidence. For automakers, these signals matter deeply. The same forces driving travel trends, tariffs, inflation, borrowing costs, geopolitical tensions, also influence vehicle demand. Las Vegas is simply the dashboard warning light showing the broader engine conditions beneath. Before we wrap up, what's your take on these shifts? Do you think Las Vegas is signaling a bigger economic turning point? How will these trends impact luxury and mainstream vehicle demand? And do you expect the 2026 rebound to boost the auto market as well? Drop your thoughts in the comments. I'd love to hear your perspective. Don't forget to subscribe to Piston Pundit so you never miss the next vehicle update or upcoming deep dive video. Thanks for watching and see you in the next one. You can now check out any of the videos on the screen. There's plenty more to explore.